Welcome to our BYOB party. Happy Friday. Happy BYOB. Bring your own booze. Bring your own beer. No, that's not what this is. That's not what
Bring your own bourbon. Is that what BYOB is?
Bourbon, baby, beer.
Bring your own baby.
Bank. Bring your own bank. Close. Become your own bank. That's the kind of BYOB we're talking about today. So we'll get started in a few minutes, right at 12 p.m. Eastern. So as you come in, please comment, let us know where you're tuning in from. Share this out. Invite if there's anyone that you know that should be on this. Invite them, tag them. And also, before we get started, make sure you grab a pen, a piece of paper, something to take notes, because you will definitely not want to miss any of this information. You definitely want to be able to implement it. So as you're coming in, please say hello. Let us know where you're coming in from. I'm just looking for the stream here that I can share it out myself, and I don't see it yet.
It's on the Martin and Chelsea page. It's not on mine.
Oh, that's why. Okay, so there it is. Oh, and you know what? When I share it, I have to be sure that I am on my page, because I end up sharing it just on the page.
Let us know if you can hear us loud and clear. I want to make sure that's all done. We're going to get started here promptly at noon.
Yes, and as we go through, feel free to write questions, put your comments. We love engagement. We'll try to get to all your questions live, but if we miss any of them, then please, we will get to them. We'll get to your answers. So ask your questions, make your comments, and also at the end of the event today, we will have a free gift for you. And we're also going to show you how you can get more. So the information that you're going to learn today, we're going to show you how you can take the next step to actually implement it into your own financial house. And as we get started, we will, if you don't already know who we are, we'll tell you who we are, why we're qualified to share this information with you. And we'll get started in just 1 second. I just am going to share this really quick on my page. And then we're going to get started because it is 12 p.m. Eastern. Okay, and I just shared it. So officially welcome to the BYOB Become Your Own Bank event. And the reason that we're doing this event is because we want you to get the right information to strengthen your finances and to create the life you truly want to live. Okay, because the information that we're going to share with you today, it changed our lives and it changed our business. And it's not widely known and it's not widely shared. And so this took us a long time to be able to learn this information and implement it. And so we want to help you implement it, learn it, and implement it faster so you can start changing your financial future and create the life you truly want to live. So how do I get to the slides?
Yep, so the slides are on here.
Okay, you guys can see the slides? All right, so how to become your own bank. We're Martin and Chelsea Matthews. I'll tell you a little bit more about us in just a minute. So do I just?
Yeah.
Okay, this is our family. We're Martin and Chelsea Matthews. That's our son, William. And, you know, we weren't always on the same page together. We weren't even actually always in business together. In fact, before I met Martin, I was a single mom to William for 7 years. And I struggled to find a balance between financial success and family success. I was either spending time with William and broke, or I was making money and not spending any time with William. And I felt guilty either way. I felt like I was failing either way. And I knew there had to be a better way. And I wanted to teach him a better way. And so I knew if I wanted him to have the tools to success, I had to learn for myself and be able to teach him by example. So that really set me out on a journey to learn, like, how does money really work? What are the tools and information that I need to implement to strengthen our financial house? And so I read books, I went to seminars, and eventually I met a group of financial advisors who were teaching people how money works. They were making money doing it. And I was like, yes, this is what I want. And that's what led me to meet Mr. Matthews over here. And he was already in the financial industry. He took me under his wing, showed me the ropes. And in fact, all of our goals and the impact that we wanted to make in our life was so aligned that we ended up combining our business and combining our life. And now we get to strengthen our financial house together, reach our goals together, and also help our clients to do the same. And so, now I'll tell you a little bit about why we're actually qualified to share this information with you. So if you don't already know who we are, we're Martin and Chelsea Matthews. We're founders of M Wealth Group. Okay, so this says we have clients in 47 states, but isn't it 48 states?
It's 48 now, yeah.
We have clients in 48 states. We have a combined 21 years experience. We lead an agency of associate advisors. We held multiple licenses in the fields of investment advisory, securities, and insurance. And we're also co-authors of this book. I don't know if you can only see the slides. I think you can see it here. We're co-authors of this book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house. And so I got to go to my next slide here. We help individuals and businesses properly use cash flow to create personal wealth. And our mission is to deliver measurable results to help our clients build an unbreakable financial house and business so they can be free to live life by design. And so you've heard me mention unbreakable financial house and financial house a few times, and I'll explain exactly what that is in just a minute. But I want to tell you how we're going to deliver this information to you. And this is very important because we're not here telling you we're gurus, experts, and you should just listen to what we say and do what we say because we're so smart. No, our goal is to empower you to make your own financial decisions because everyone is in a different place. Okay, so knowledge, responsibility, and control. We're going to help increase your knowledge so that you could take more responsibility for your decisions and your actions. And that allows you to have more control over your life, your results, your cash flow, all of that. So this is very important. We want to empower you to take responsibility and have control over your financial future. Now, what we've discovered in our business and our life is that everyone has a financial house. Some people have a financial mansion. Some people have a financial shack. So, and some people are in between. And it just depends on where you are and where you want to go. But one thing that's the same in every single financial house is there are 6 areas. We call them the 6 building blocks to an unbreakable financial house. I'm going to tell you really quickly what they are, and then I'm going to tell you which 2 we're going to focus on today. So the first building block is cash flow. That's the money coming in and going out. Always focusing on increasing your cash flow. Okay, debt management is understanding the difference between good debt and bad debt and how to use good debt to increase your wealth. And building block number 3 is reserves. We just saw how important having reserves is through this worldwide shutdown we had. Even people that were making a lot of money, if they didn't have proper reserves, they were in financial emergency. Okay, so it's very important to have reserves. Building block number 4 is proper protection. This is having the right kinds and the right amounts of insurance, specifically life insurance. It ensures the financial survival of your family, your personal finances, your business finances if you're a business owner. And building block number 4 is build wealth. We all want to build wealth, generational wealth. We want it to last, right? And so build wealth is a very important building block. And build legacy is building block number 6, having the right documents in place so that everything that you've worked so hard to create actually does what you want it to do, whether you're here or not, for generations. Okay, now today, these are the 2 building blocks that we're going to focus on. Proper protection, building block number 4, and build wealth, building block number 5. And Martin is going to deep dive today into these two. And when you get these right, then it affects all of your other building blocks and your whole financial house gets strengthened. Okay, so as Martin deep dives into these, I want you to be thinking about where you are now in your financial house and what is the next step that can help you strengthen your financial house. And make sure you take notes, ask questions, take it away.
So, hey, thanks, Chelsea.
Hey, you're welcome, Martin.
It's so funny to call her by her name.
I know, it sounds weird to call you Martin.
So look, we the topic of this is how to become your own bank. We're going to talk about that. We're going to talk about strategies we use. We're going to show you how you can actually see examples of this for yourself. So make sure to stay tuned to the end. We'll talk about all of that. How do you actually set something like this up for yourself? And also there's a free gift for you guys at the end of the webinar. So, and look, when it comes to building wealth, there is a big problem. There's lots of different problems you encounter into. When it comes to wealth, you got to think of it like a game. So building wealth like a game. Every game has some obstacles you got to overcome, barriers. And once you understand what those barriers are, you can handle them and play the game well. So there's a big problem when it comes to building wealth. Big problem is that you're not being educated about the enemies of your wealth. What are the things in opposition to you as you go on your wealth journey? And when you're trying to build financial freedom, whatever it is you're trying to do, what are going to be those enemies of your wealth? And if you handle them, then it makes your path a lot easier to building wealth and becoming financially free. So the three biggest enemies of your wealth, these are the three biggest opposition that you face on your wealth journey. Everybody's got to handle these. Those three biggest enemies of your wealth are one, taxes. So look, taxes, everybody understands that. Nobody likes to pay them. Okay, nobody likes taxes because nobody's really sure exactly what they get for their taxes. But understand that taxes is the number one enemy of your wealth. So whatever you do with your money, one of the questions you have to always ask is, what is going to be the impact of taxes? How are taxes going to affect what I'm doing, the strategy I'm running? And also, what's tax going to look like in the future? Because your government controls that to some degree, and then you have some control over that to some degree as well, based on using a tax code to your advantage. And if you guys have any questions, things along the way, drop that in the comments. We'll answer your questions along the way as well. So second enemy of your wealth is inflation. We've been talking about these three enemies for a long time. For well over a decade, we've talked about these enemies. Now this year, you're seeing impact of inflation. When the government prints a lot of money, it inflates the money supply. So about a quarter of all the money you see existing today did not exist before 2020. So the government went into overdrive and printing money. They inflated the money supply. When you inflate the money supply, prices rise up to meet that new supply that's been in the market, because people know, hey, they just injected a bunch of money into the marketplace. So prices rise. When prices rise, people feel that. You go to the grocery store, you go to all these different places, and you feel that impact. That's the impact of inflation. When inflation happens, it affects your money, your cash, things in bank accounts, because your money has to keep up with the rate of inflation. It used to be inflation historically was around 3% or so. Now it's much, much higher than that. So whatever you do with your money, wherever you put your money, has to keep up with inflation. If it's not keeping up with inflation, it is losing value every day. It's shrinking. It's like your money just got out of a cold shower.
Say no to shrinkage.
Say no to shrinkage. Don't let your money get into the cold shower. Okay, it's going to shrink. That's what's happening every day. Trillions of dollars in bank account is shrinking in value. And this is also why people are very interested in digital currencies. People are interested in Bitcoin and other currencies because understand the impact of inflation. We'll talk about that as we go through here and why that becomes so important and how you can actually leverage this strategy to actually do crypto and how to do it safely and effectively, how to use it for real estate, how to use it if you want to invest in the stock market. You can use this foundational strategy to do all of those things and actually give yourself more safety and accelerate your wealth. So the third enemy of your wealth is market losses. Doesn't matter what market it is, whether it's stock market, whether it's crypto market, whatever market it is, market losses, if you don't know what you're doing and you expose yourself to losses, it reduces the amount of money you have working for you. The more money you have working for you, the better your outcomes generally are. When you take losses are setbacks. So those are
And
the
you
three
don't
biggest
want
things
to
you go up.
expose yourself when you've had shrinkage.
Yes, you don't want to expose yourself when you've had shrinkage. She's on a roll today, boy. Usually it's me that comes up with those kinds of jokes, but
You know, I gotta throw them in there sometimes.
I'm rubbing off on her. Taxes, inflation, market losses. Three biggest oppositions, enemies in the game of wealth that you got to handle. And we'll talk about how this strategy will allow you to do that. So we'll show you a strategy that the wealthy banks, big corporations use to defeat these three enemies. Okay. So we call this strategy become your own bank because it leads to number one, clarity. Wherever you're trying to go with your finances, it doesn't help you to be scattered. You got to be clear in what you're trying to do. Clarity, certainty. Certainty is like, how can I increase the confidence and certainty and predictability that I know exactly what's going to happen to my money? How do I predict exactly what's going to happen to my money and know with confidence I can create that outcome?
I want to get it up and keep it up.
Get it up and keep it up. So clarity, certainty, and control. You want to be in control of your money and not have your money be in control of you. You want to be in control of the moves you make, the things you do, because that's how you get to what you want out of life. Having clarity, certainty, and control, especially in the area of your finances, because money happens to just be a resource for you to get what you want. Okay. So before we get into the strategy itself, I want you to start to slow down for a second and think about how you view money. Because the way you view money will impact how you use the strategy. So there's three ways people view money. One, as a spender.
Used to be.
Two, as a saver.
Used to be.
Three, as a banker. What are the differences between these two, bankers and wealth creators? What's the difference between these three? All right. So first, spender views money as a way to buy stuff, right? I get money, I want to buy stuff. Well, all kinds of crap. They buy trinkets, they buy all kinds of stuff. They may not necessarily buy assets. They buy all kinds of random things. Every purchase costs you interest. I want you to understand, anytime you make a purchase, it costs you interest because that's money that's not earning interest for you. That's how you have to start looking and thinking about money. Every purchase you make costs interest. So the spender, when he borrows, because let's say the spender he spends all his money, doesn't have enough money, so he borrows money. Whenever he borrows, he pays interest. And then whenever he pays cash, so a spender can be somebody who borrows and a spender can be somebody who pays cash. Whenever you borrow, you pay interest. When you pay cash, you give up the interest that you would have earned. Now, let me give you this as an example. So we'll use an analogy of a car, and we'll use this theme throughout this webinar of using if somebody finances a car or to pay cash for a car. Doesn't matter if it's a car, if it's a house, if it's whatever it is you're going to do. How can you make those transactions effectively and keep your money working for you at the same time? That would be the most ideal situation to be in. So let's say a spender buys a $30,000 car every 5 years at 5% interest, 5.5% interest. After 11 purchases, right? Buys a car every 5 years. After 11 purchases, the person who borrowed money has spent $378,000 just on cars. The person who paid cash spent $330,000 on cars. So as you can see, the person who borrowed money because they paid interest, they paid more than if they paid cash. So because of that, this makes people think it's always best to pay cash because they think, well, I don't want to pay interest, so I should pay cash. That's usually where most people think. They think in terms of black and white. Something's got to be good or bad, black or white. They don't see the middle areas and think, is this the best way? What if the best way isn't black or white? What if the best way is a combination? What if the best way is an area where it's a combination of both things? So the saver first has to save money. If you're going to be a saver to pay cash, anybody who pays cash, you first have to save the money, right? You don't magically just have the money there. You either have to save the money or you inherited the money or something, but you at least have to store that money. Then goes and pays cash for it. Now, so we talk about the saver and we talk about the spender. How does the banker view money? The banker knows something else to be true. The cash buyer, here's what the banker knows. The cash buyer, the guy who pays cash for everything, and the guy who borrows, they both end up back at zero. The cash buyer saves money, spends it on the item he wants to buy, ends up back at zero. He spent his cash. He's back at zero. He now has to save the cash again. The guy who borrowed, what's he trying to do? He's trying to get back to zero because he went negative. He went into debt to buy the thing. So he pays off all his debt and he ends up where? Back at zero. The cash buyer and the guy who borrowed both end up back at zero. Does that make sense? So understanding that zero is not where you want to be. You want to be increasing your wealth, not just getting out of debt or back at zero because you spent all your cash.
Unless zero taxes.
Zero taxes, that's where you want to be when it comes. The only zero that's great is zero losses and zero taxes. So the banker realizes that it's more important. Earning interest is more important than paying interest. The interest you earn is senior to interest you have to pay. So the banker always keeps his money working. Now, think about this for a second. If you go to the bank, right, and you go into the vault, is there cash just always sitting there? No. Primary way banks make money is by taking in, first they take in deposits and they make loans. They earn interest off of loans they make. So when you start thinking of yourself as a banker, you have to start thinking of yourself in that view. How do I take in money and then make money through either lending it or using it for assets that would pay me money? So your loan is debt to you, but is an asset to the bank because it generates money for the bank. So they realize that earning them interest is more important than interest they have to pay to you for storing money in the bank. So you see, the bank pays you a little tiny bit of interest, but they collect back a lot more interest from others. Okay.
Banks are excellent receivers.
Banks are great receivers.
Be like a bank and be a great receiver.
And I'd be looking at that and seeing if there's any questions or comments I need to pay attention to because I can't see from here.
Jeremy says better to rob a gas station versus a bank.
Yeah.
They
they don't have that money sitting in there, man. We did go to the Federal Reserve and they do have a vault. In the vault, they don't even let people in the vault. It's machines that go into the vault and put this in there, but that's the Federal Reserve Bank. Normal commercial banks, they don't keep a lot of cash in there.
Humans don't even go where the cash is, but where the cash is, humans are shredding all day long, shredding
at the
cash.
Federal Reserve in Atlanta here. So this is why understanding this concept, we'll get into how to become your own bank, but understanding this concept first is why billionaires who can easily pay cash often get mortgages. Billionaires want to keep their money working. So they understand if I can keep my money working, then I will make sense. Maybe it makes sense for me to borrow. So even though people who have money to pay cash often borrow, billionaires and rich people borrow a lot of money for it. There's a lot of different reasons behind that. So what Beyonce and these other billionaires have in common, massive mortgages. So all these Wall Street guys, these billionaires, all of them, they finance their homes. A lot of people think, oh, if I have a lot of money, I would just pay cash. If I got all this money, I will pay cash for my home. A lot of these people finance, they have mortgages, they don't pay cash for their stuff. Why do they not pay cash for their stuff? Because they don't think like a saver. They don't think like a spender. They think like a banker. They think, how do I keep my money working for me and buy the house at the same time? How do I do both? I don't have to do one or the other. How can I do both? So Mark Zuckerberg has a mortgage. He refinanced his house, $6 million property, refinanced it so that he could pay a lower interest rate. Why would Mark Zuckerberg go through the trouble? It takes longer to sign the mortgage documents than it would take him to write a check for $6 million. Because Mark understands.
Unless it's you writing the check.
Unless it's me writing. Just a little inside joke that she has from stuff. Because I made a mistake on a check the other day. So, but Mark Zuckerberg understands keeping his money working for him is more important than dumping and paying cash for it. So he uses leverage to be able to do that. That's why Mark Zuckerberg has a mortgage. Warren Buffett, everybody always talks about Warren Buffett. He still lives in his first house, but Warren Buffett has bought multiple houses since his first property. So he in his article actually talked about his mortgage borrowing strategy. At one point, he was the richest man in the world. So why does Warren Buffett, Mark Zuckerberg, Beyonce, Jay-Z, all these wealthy people, why do they still borrow money? Because they understand when you have money earning interest for you, it is that interest you're earning is more important than paying out interest. So it makes sense for them to do this. Even Elon Musk doesn't take a salary from Tesla or SpaceX. He actually, because his stocks are appreciating in value and that's an asset for him, he takes loans against Tesla stock. Because for one, when you take a loan, it's not taxed. So when Elon Musk takes a loan against Tesla stock, he doesn't pay any taxes because the loan's not taxed. If he would sell Tesla stock and take that money, that would be taxed. See? So I want you to understand he had to do that recently because he got some options that when he reached certain targets, he could get options to exercise for getting more Tesla stock. So he had to sell some of those, and he now realized those gains, so he had to pay taxes on them. But whenever you take loans against it, so the guy who's from Snapchat did the same thing. The Snapchat went public. He takes loans against the stocks, doesn't have to pay taxes on it. These are strategies wealthy people use, and you can do the same thing if you have the right vehicles in place. You can do it at your level. So before I get into the other piece here, it's understanding this question. It's a very important question to understand how to think like a wealth creator. If your money is earning 4%, your money's earning 4%, would it make sense to borrow money at 6%? I want you guys to drop in the comments what you think about that. If your money's earning 4%, would it make sense to borrow money at 6%? Assuming your 4% is compounding. If your money's earning 4%, would it make sense to borrow money at 6%? What do you guys think the answer is? What would you say to me if you're like, oh, I'm earning 4, and somebody said, hey, borrow money at 6? What do you think that is?
Mitch wants to have his own coin.
Whenever we ask this question, the majority of people say, no, it does not make sense. It does not make sense for them to borrow money at 6%. Because what are they looking at? They're looking at black and white. They're looking at 4% and 6%. That's all they look at and that's all they see. However, you got to think beyond that. There's a little bit of communication lie between.
No way. Someone says no way. Someone says yes, makes sense. Yes, keep the seed growing. I say no, it won't help. Borrow to leverage.
Yeah, somebody on this other one says no, 4% is to be sitting. Understand. So let's look at it. Always look for how do the numbers work? How do the scenarios work? So I'll give you here's a real life example. So let me go back here. This is highlighted. Remember our example earlier, we talked about buying a $30,000 car. So here's what a lot of people do. The person's got 30 grand sitting in their account, earning 4%, whatever account it is. We're going to call it whatever magical account it's in. We won't call it bank account because bank accounts aren't paying you 4%. So they're earning 4% in an account. And they go and see the loan on the car and it's 6%. And so they say, no, 6% is higher than 4%. So I should take the money out of my bank account and I should pay cash for this car. And in their mind, they've done a very smart thing economically. But if you look at the numbers, here's what it actually shows. If you were paying that car off in 5 years, that's the top highlighted line. That's 60 payments you make, 6%, you make $580 payments per month. You would pay a total of $34,799 for that car, right? So you pay some interest. What if the person kept their money working at 4%? They would have earned $36,630. In this particular scenario, this person, it would have made more sense for them to keep their money working, because had they keep their money working, it would have ended up with more money in their account at the end of that 5 years than what they paid in interest. See, people only see black and white. They see one or the other. They see 4% or 6%. When your money is compounding, it's building on top of itself. So you see, in this scenario, this person would have been better off keeping their money working, financing a car, because their money would have ended up with more money than if they would have just paid cash for the car, right? Mm-hmm. So when you start thinking like a wealth creator, you ask different questions. Every purchase costs us interest. We either pay up or give up interest. So the person buying a car is either going to give up interest because he pays cash for it, or he's going to pay interest because he finances. So the banker thinks this way. The banker, the wealth creator, thinks this way. What if we could use our money without giving up the interest it earned? What if I could have my money in that account working for me, and I could still use it to buy the car? How can I do both? What if I don't have to do one or the other? So in becoming your own bank, here are the steps a person takes. Number one, Person would create a pool of money. You got to store money somewhere. You got to, number two, put that money to work earning compound interest. In that example, between the 4% and 6%, you can see how the compound interest, because the person, compound interest is your interest from last year gets added to your interest this year, and it keeps building on top of itself.
And
Right?
really quick, Jeremy, this ties into your question number 2.
What's that?
So he says, how does one invest into real estate that produces cash flow when you don't have a lump sum but can pay $500 a month over time?
Okay, I'll answer that. That also goes in a create pool of money. So let's say
That's what I just said.
Yeah.
He's getting into it
Oh,
right now.
number 2. Yes, absolutely. So you can put your money to work, even if you, whether you have money monthly or you have a lump sum of money, you can still build your pool of money, accumulate money, put it to work in an interest bearing account that compounds. It builds on top of itself like a snowball. While that's building on top of itself, you never want to interrupt your money compounding. Meaning, I don't want to just take it out and stop the compounding and go pay cash for something. Because now what did I just do? I just cut off my compounding. I wanted to keep building forever. But how do I then use this money when I want to buy a car, when I want to buy an investment, when I want to buy an asset, when I want to buy real estate, when I want to buy crypto? All of that. You can use that pool of money as collateral when you need funds, which means I can go and take a loan against that money. Remember, a bank is a financial institution that takes in deposits and makes loans. I can essentially put my money into a vehicle where I can do the same thing. I can make deposits into that vehicle and I can take loans against it while my money stays in there and continues to compound. So to build our own bank, we use properly designed life insurance policies that builds cash.
Ding, ding, ding.
Here's why. Now, before I go into here's why, I want you to understand there's different types of life insurance. Most people may have a very basic type of life insurance. Most people think of life insurance as something that pays when a person dies. That is a key function of life insurance. It pays upon the death of a person. You have term life insurance that pays for a period of time. And you have permanent life insurance that builds cash. Permanent life insurance can allow you to store money inside of a life insurance policy that you can utilize as your own bank. Now, I own both. I don't think one's better than the other or anything like that. I own both of them myself. Chelsea and I all own different types of life insurance on ourselves.
Even our son.
Our son, we're using this strategy for our son because he's going to use it to buy real estate. We'll get to that part in a second. But properly designed, most policies that try to achieve this are not properly designed. If you just go online, you Google life insurance quote, you're going to get a very basic life insurance policy that doesn't do this kind of stuff. We're talking about very customized life insurance policies. And I'm going to show you who use them. Wealthy people, I'm going to show you examples of wealthy people who use them. I'm going to show you how, regardless of your political views, how the current president of the United States uses this strategy. He's been using it since the 80s. How a lot of wealthy people, how rappers, athletes, all these people use this particular strategy as a foundation for building and accelerating the wealth. So here's why. Number one, without a life insurance policy, I suffer no losses. So I'm not putting my money at risk. I could potentially earn a higher interest rate because we use life insurance policy. We're banking through life insurance. We're using life insurance policy as a store of our money. We store money inside of the vehicle and use it to buy other assets. By the way, we're going to show you guys how we'll show you numbers for yourself. We'll show you how you can get an appointment with us. It won't cost you anything to do an appointment with us, or someone from either us or someone from our team, and how you can see numbers for yourself. How this will work specifically for you, because all these plans have to be customized to you and your financial position. So no losses. So we store money inside of a bank policy because we can earn higher interest rates than sitting at the bank. Remember, inflation's kicking your ass at the bank. It's losing value every single day, shrinking. So I got to figure out how to handle that enemy of my wealth by putting my money somewhere where I can earn higher interest rates than I would get at the bank. Number two, guarantees. I can have guarantees that money will pay out when I die. I can have guarantees I can take a loan against it. And I can have some of these policies have guarantees on how much they will credit you each year. I can earn compound interest via my life insurance policy, building cash. Very, very important to understand. Compound interest matters. Is how you can, one of the ways that your wealth keeps building and building and building. And you never want to interrupt your compound interest. Liquidity, use, and control. Liquidity means I can get access to the funds fast whenever I need it. If something comes up, if a real estate deal comes up, if something I want to do happens, I need to be able to get access to it. Liquidity, use, and control. I control when I take a loan against my policy. I can even control how and when I pay the loan back. I control that. When I take a loan against my life insurance policy, there's no fixed repayment schedule on it. I control when I do that. This is important for real estate investors, people who flip properties. So let's say I'm doing a flip and I leverage my policy to go and buy a real estate deal. I want to control when I pay that loan back. I don't want to have to start paying it back the next month if I don't need to. What if it takes me a little bit longer to fix up that property to flip it? Then once I flip that property, I can pay the loan off and keep my profits, but I can control that. See, life insurance loans allow you to do that, where you can use the money and have control over how you can pay the loans back. Excuse me. Asset protection means my money inside of the policies protect us from lawsuits. If you're a high income earner, if you're a doctor, some kind of professional like that, a lot of times you have the propensity to be sued. Has protection in the courts. So I have asset protection in various ways. I can protect that money inside of the policy.
Better protect that in.
Yeah. So tax-free, I can access the money on a tax advantage, tax-free basis. So I could take withdrawals, I could take loans against the policy, all of that allowing me to not have to pay taxes on the growth of the money. So it gives me certain advantages in that sense. Collateral. That means if I have money in my policy, in my own bank, my quote unquote bank, using my life insurance policy, I can use that money as collateral for a loan against it. Then I can take that loan I received and put it to buy assets. So let's say I got my money working in my policy is in one location. I leverage it to put it into another location. I borrow against it, put it into another location that's going to further earn me more interest. Maybe I buy real estate with it. Maybe I use it to buy a business, buy other assets, use it to buy a car, use it to do many other different things with it. Use it if I want to put that towards crypto. And towards the end, I'll talk about different strategies on how you can actually minimize risk when it comes to crypto and how you can use this as a foundational strategy and how this and crypto fits in on a chart of risk. Before the end, I'm going to talk about a chart of risk levels and how you minimize your risk and so you can maximize your upsides in this. Disability benefits. What if on my wealth building journey, I become disabled? How am I going to keep everything going? The life insurance policy can pay for that. Income for life, which means I can convert my life insurance policy into cash flow that pays me continually over and over and over again.
Oh, yeah.
Tax-free income during retirement. So I can do that as well. Lots of different ways you can use this because you can customize it. And I want you to understand very few financial people, insurance people understand how to properly design these policies to do this. This is a specialty. Chelsea and I do this for a lot of high net worth people, a lot of high income earners who put away hundreds of thousands of dollars a year into policies like this. So understand that your average person, that's your guy down the street at the credit union, that's not their specialty. The local State Farm agent, nothing against State Farm, but this is not necessarily their specialty. That's not necessarily what they're doing. Maybe giving you a very basic type of life insurance that's not designed or customized to do this. Chelsea and I specialize in doing this, and we train our team on how to do this effectively so that clients can maximize how to use the strategy. So I can use it to fund my trust. I can use it to create generational wealth for my family. So Chelsea and I have a trust. So it's like the life insurance policies would fund our trust in addition to our business and other assets. Generational wealth for my family. It can go to create multiple generations of wealth and bypasses probate. Probate is the court process a person goes through when a person dies. You know, they got to go through and probate the will and all that. The life insurance policy goes directly to who I wanted to go to without going through the court probate process. So you see, there's lots of different benefits and reasons we use it. Now, here's an example. If you guys have any questions on there, drop in the comments. Let me know. So here's an example of how you use it to buy real estate. So it's a visual example. A lot of this seminar is meant to be high level, and then we can do a free call with you where we go into a specific examples for you. So visually, first, a person will fund on the left there. It says high cash value life insurance. I want to design it so that I can maximize the cash in the policy. So I got high cash value life insurance. And then as I build that up and utilizing that as my own bank, I can leverage it to buy real estate, and that real estate generates cash flow. So as that cash flow comes in, I can use that to pay down the debt of the life insurance policy, or I can use it for my lifestyle. I can choose whatever I want to do with it, right? So then I can take multiple loans against my policy and buy multiple pieces of real estate that all generate cash flow for me, using my life insurance as the foundation to which I'm doing all of these different things. Provides another layer of stability, because if I died, the death benefit on the life insurance policy would pay off any outstanding loans I have on the policy anyway, and send the rest of the money to my family, and my family still keeps that real estate, and that real estate still cash flows. So
really quick, Keith, a trust is designed, it's a document put in place with your estate plan, and it's a service that we offer. So if it's something that you're interested in looking at, you can message us, or you can also request a strategy call. So, and we'll have a link for it at the end.
Yeah, well, sure. You guys getting some value out of this? Let me know. Drop in the comments if you're liking what we're talking about. If you're learning something new, if you're getting some value out of this, let us know. Okay. So another thing is, banks actually use life insurance. Banks actually own life insurance. So I told you, I'll talk about how wealthy individuals, banks, athletes, all these different people use life insurance, including the current president of the United States. Whether you like him or not, that's not what this is about. It's a strategy that even the current president of the United States use, and you can do the same thing. Do things that wealthy people are doing so that you can get in a better position. So it's called bank-owned life insurance. It says, and highlighted there, it says, although it may sound strange, bank-owned life insurance is a tax shelter for the bank and can also offer it a tax-free source of funds. So banks actually own a lot of life insurance. Bank of America, Chase, Wells Fargo, all of these banks owns hundreds of billions of dollars in life insurance. It's tier one capital. From FDIC considers it tier one capital. Anybody can go look this up and see how much assets all these banks have inside a life insurance policy.
And Pamela, no, you can't really get a policy like this from your local bank. They're not really specialized to create these kind of policies. So you definitely want something like how Martin was saying, an expert like Martin who designs these policies specifically for your financial needs.
Yeah. So and we do business with a lot of different major insurance companies, and not every insurance companies build plans to do this particular strategy. So you got to know the right insurance companies that you're going to, and they don't really advertise it very much because it's a specialty. So it's like through webinars like this, you learn about it, and then your next step would be you can schedule a strategy call with us. We'll go over and explain to you for your situation if it's appropriate, if it makes sense, and how that works. So thanks, guys. People said definitely liking this, most definitely. All right, awesome. So banks also use it. So you understand, you put your money in the bank, they take it and put it inside a life insurance policy, hundreds of billions of dollars. They're playing a different game. You have to understand the rules of the game these different entities are playing, because as it says, there is a tax-free source of funds for the bank. So you can do the same thing for yourself. This is also another interesting one. If you guys watch college football, so there's a coach, Jim Harbaugh. So this was on ESPN's website. So a few years ago, Jim Harbaugh negotiated with Michigan increase to his compensation. And it was in the form of a life insurance loan. The University of Michigan gave him money as a loan to put inside of a life insurance policy. Anytime you see these things that seem odd or different, or why would somebody do that? Anytime you see these kinds of things, you always have to look deeper and say, why would it do it that way? Why does Elon Musk take a loan against his stock? Why does Jay-Z and Beyonce have massive mortgage when they can pay cash? Why does Mark Zuckerberg refinance his house when he can pay cash? Ask these kinds of questions. The better questions you ask, the better results you're going to get in life. The quality of your questions will determine some of the quality of your results. So it says here in highlights, in addition to paying $5 million salary for each of the remaining 6 years on his deal, so you're getting a $5 million salary already. Now, if you're making $5 million on your W-2 or your 1099, whatever, you got to pay a lot of taxes on that. So it says Michigan will loan Harbaugh $4 million. He renegotiated this in 2016, and an additional $2 million for the following 5 years to pay the premium on a life insurance policy. Why does he take it as a loan? Because, very simply, loans are not taxed. Loans aren't taxed. So the loan that Jim Harbaugh receives from the University of Michigan, there's no taxes on that. He puts that inside of a life insurance policy to keep that compounding. Remember? So you keep that compounding. Somebody says, if the banks don't offer these.
Yeah, I got the questions,
Okay.
He tries to handle everything because he's such an expert, but I could do this one thing.
Okay, go for it.
So Keith says, if the banks don't offer these deals, why is it bank owned?
The banks don't. Thanks. Good question. The bank don't own the insurance company. The banks buy life insurance policies. Banks don't actually offer life insurance. A bank is not an insurance company. A bank is a bank. They buy life insurance. So bank owned means a bank owns a life insurance policy, not the bank owns a life insurance company.
Then they may have employees that have a life insurance license, but it's like an added service. It's not really like their specialty.
Yeah. So if you're a high net worth individual and you use private banking services at a bank, sometimes you could get access to this. But usually you will probably have a few $1 million in the bank before you get access to the private banking services in order for somebody to build this type of plan for you. Most of the time, what they're doing is they're getting people who go to the teller and they're getting the tellers to, try to route you, go see the financial person in there. And then they will sell you a very general form of life insurance because that generates additional revenue for the bank. So they're selling you that. They're not trying to build this strategy out for you like this. They're giving you a very general type of life insurance. But if you are in a private banking services, meaning you generally have a few $1 million, typically $5 million or so relationship with that bank, and sometimes they give you access to some of these kinds of services. But bank owned doesn't mean the bank owns an insurance company. It just means the bank bought life insurance. They put money inside of a life insurance policy, and the bank owns the policy, not the company. So that's why a lot of them do it. They use it for themselves, but they don't necessarily offer at this level to the vast majority of their clients. So I hope that answers the question. Does that answer your questions? Let me know.
Do you want me to tell you another question?
Sure.
Okay. Can you deposit directly to a whole life policy as you can to a bank account? If so, is that deposit a write-off?
It depends. A lot of questions financially is it depends. So yes, you can't put money directly into it just like you can put money into a bank account. We have executives who use this. So sometimes if you are using this, the business can pay for it, put money in there for you if you are an executive. So you can give yourself an executive bonus or executive compensation plan, and that can flow into the policy. It creates an immediate tax deduction for the business. However, it could be because it comes to you as a bonus, it could be taxable to the executive. So it depends on if the company needs a tax deduction, they can definitely do that. There's different ways to do it. Generally, money inside of a life insurance policy is going in after taxes, unless you're trying to create a tax deduction for the business. And then you can have it as an executive compensation plan where it would create a tax deduction for the business. All right. And if you want to know more about it for specific things, then we can do a call with you where we go over it for your specific situation.
And Pamela, yes, you can get access to this program without having $1 million in savings. I'll put the link again too, and we'll put it at the end, but you can request a strategy call where we can actually put customized numbers based on your financial situation to see what it would look like for you.
Yeah. So, here, this is in the Washington Post. Since 1983, Biden has borrowed against the cash value of life insurance policies. So in 1983, he started buying life insurance policies. He owns 6 of these policies. So he can own multiple policies. He's been using them since then, since the 80s. He's been borrowing against his policies and using it on some level as his own bank. So understand that you can do the same thing. It's not exclusive to only wealthy people. You want to be in a good financial position, but we can show you how you can start one based on where you are financially and build up to where you want to be. But it's a vehicle that a lot of these people are using. So I'm not just telling you this stuff, I'm showing you to you. I'm showing you how Jim Harbaugh and all these wealthy people, even the current president of the United States, use this strategy, literally borrows against this policy. He's been doing it for decades, but yet they never talk about it. Why? Because loans are not taxed. You understand? Loans are not taxed. You don't even have to report it as when you take a loan against a policy. When you go to finance a car, The car may be taxed, the purchase may be taxed, but the loan you receive is not taxed to you as income. Same thing with a life insurance loan. So it's an important distinction to understand. Um, this year, there's a lot of numbers on the screen, so I just thought I would give you guys a general example so that you can see what this looks like. This is an example of somebody putting in, they're paying $1,000 a month into the policy. A lot of clients put in more. Some clients may put in less. On average, we have clients who have put in $3,000 to $5,000 a month. So somewhere between $60,000 a year is what a lot of our clients do. Now, understand, we have a lot of high income earning clients, so a lot of them have the income to put that away. Even if you're just getting started, we can show you how you can put in less than that and build up towards it, but you can get a plan started for yourself if it is appropriate for you. So in this example, this 35-year-old client puts in $1,000 a month, and does that to age 70. At age 70, he's got $1,339,000 built up in a policy with a $1.6 million death benefit. So this person can use this money. That's only putting in $1,000 a month. And life insurance is not an investment. We're using life insurance to bank through life insurance because we can earn a higher interest rate than we would get at the bank, and because of inflation. So I use the life insurance policy to buy investments. Life insurance is not an investment. It's just I'm storing my money in a policy for these benefits. Then I can leverage it to buy other assets, you see. And I want to talk about your risk reward ratio here in a second to understand how do you balance this with other assets that you're going to buy, including cryptocurrencies, and how that can accelerate your wealth. Because when you have more control, you can accelerate things and speed up your time once you understand how to manage your risk. So this is another example here showing how the person can use it sooner. In a few years into the policy, the person in this example, the guy's built up $100,000. He can take a loan against $100,000 whenever you want. You can take a loan. There's some policies you can take a loan against the next week, depending on if you're putting in like a lump sum stuff. Sometimes people have a lump sum sitting in the bank, and they want to like dump money into the policy. You can do that. You can take a loan against it the next week. We've got clients do that to buy real estate, and then other people want to put money in monthly. So usually putting money in monthly, then maybe after the first year, then you can start accessing it after the first year or so. So you don't have to wait forever. This is not like a retirement account where you got to wait till 60 years old to start using it. You can use it a lot sooner while your money's compounding. Understand, you can have your money working for you and leverage it to use it in other assets, but it has to be customized for your specific situation. Because we have clients who put $20,000 a month into policies like this. Clients who put $400,000 a year into policies like this. It's designed for them. That may not be you. Maybe your income is above that. Maybe you can put $400,000 a year. I don't know. Or maybe you can't. But then you look at where you are and if the strategy is appropriate for you, because then you can have your money working in one location and leverage it to buy other assets, right? So onto the crypto. We're about to wrap up here. Make sure if you guys want a free strategy call with us, you go to 6buildingblocks.com/strategy. You can request a free strategy call over there. Do it at the end of the webinar. Stay tuned. We're going to give you a free gift at the end of the webinar, though. Crypto. So some of you guys may know the little dog on the left, Dogecoin. Dogecoin is, I think, like the number 4th talked about coin on Twitter in the last year, right? I bought Dogecoin. I bought it mostly for fun. And I think I was on Twitter at like 1 a.m. reading stuff. And I'm like, oh, somebody's talking about this. And I bought it just for fun. And I realized what people are hyping this stuff up and everything. In the crypto space, there's ways to manage risk and understand it. I won't get into a whole thing on crypto, but I've been doing, to give you some context, let me start with this. A few years ago, a couple of years ago, Bitcoin was at 4,000. And a client of mine reached out and said, hey, people always ask, because we're in the financial space, people always ask us about different things. And he said, should I buy some Bitcoin? What do you think about me buying some Bitcoin? Because I handle somebody's finances, so he was like reaching out to me, asking me that question. So I said, yeah, absolutely. You can buy some Bitcoin. I'm like, even if it went down to zero, you'll be fine financially because the guy's a high income earner and all that stuff. But he had been funding his policy for years. And I said, why don't we leverage your life insurance policy? You already got money in the policy. Why don't we use that? And you can buy crypto. And I said, in the worst case scenario, if your crypto lost, you just, all you did was take a loan against your policy. And you just paid that loan off and you'll be fine. But if it works out well, you basically put none of your actual money in there. You took a loan against your policy to do it. So we're just something we're testing out. And by the way, I need when I'm talking about crypto, this is not financial advice when I'm talking about crypto. We're licensed for other stuff. There's no licenses for crypto. So this part of this whole thing is just for information purposes. Okay. So the client uses
life but the other pieces we are licensed for.
The other pieces we are licensed. Got to be licensed to talk about insurance and all the other stuff.
Yeah.
So the client bought Bitcoin at 4,000, and then when Bitcoin just ran to 16,000, the client then sold some of the Bitcoin to pay off the loan he took against his policy, and he just left the rest of the money in there. So now Bitcoin's at over 50,000. So why could the client afford to wait? Because number one, he wasn't really taking on a lot of excessive risks. If it went down to zero, he would have been fine. He was still funding his life insurance policy that he leveraged. So if he leveraged life insurance policy, he was still putting money into his policy every month. So that would have been fine. But he used the life insurance policy to buy crypto. And then because it went up, he exited it, and he could then hold the crypto. He's basically playing with what they call house money because he was using his gains now. He had no money in the deal anyway because he leveraged his policy to do it. So you understand that's one of the things that he had done, and so he was able to hold over this time. What happens is the picture on the right, people think digital currency is going to go to the moon. It's going to go, and you hear everybody hyping it up. And another one people talk about was Shiba Inu and all these different coins, and people start looking for all these different things because they want to buy something super low and it goes all the way to the moon and goes super high and they become rich, and you hear all these stories all the time. In that picture, you see, based on that picture, to the moon, and then it dropped. It's very easy for you to get wrecked in crypto if you don't have a concept of what you are doing. So over the last, for a while, I've been kind of studying it and understanding it and doing some of it myself. Then recently, a few months ago, I started learning I got connected with a group of people, very smart people in this field, very, very smart, and started going through and learning all the different things that they're doing in this space. And they're doing lots of different things where you can realize your upside and mitigate your risk so that you can actually accelerate your wealth. So, and there's lots of ways you can do that because crypto is a space where it has tremendous upside, but you don't want to just jump into every single thing you think is going to go up and get wrecked. So that's what happened to people. So some of these are guys I know personally that I can tell you have made millions per year doing crypto. There are guys who, some of them have made mistakes, so they know what to avoid, different things to do. So there's different strategies. And there's a whole ecosystem of where you can learn how to do this kind of stuff. And I'll go to this next page here, and we'll wrap up here in a second. So in this chart, I drew this chart in my office, and I wanted you to understand balancing risk versus upside. So you may not be able to see it very clearly. I'll read what it is. So as it goes up, it generally represents, as it goes up and forward, it generally represents higher risk, but it also should represent the expected upside. If I'm taking on more risk, I'm doing it because I expect a higher upside. So those little dots are different asset classes that you can have. So on the very bottom, you have cash. No risk, but actually the risk is I'm going to underperform inflation. Mm-hmm. The next one up there is bonds. That's when you lend a company money. You buy their bonds, is lending them money. The third one is high yield bonds. Sometimes some certain bonds are a little riskier than others, so they call high yield. They try to pay you more on there. So corporate bonds, different things like that, a little bit. But they don't, all of those, I circle those three, cash, bonds, high yield bonds. They don't take on a lot of market risk, but they all currently are underperforming inflation. Inflation is a major issue you have to think about handling. Then above that circle, where you're not losing money and you have more things stable, is I put life insurance, real estate. life insurance and real estate. So we've had a lot of clients leverage life insurance to buy real estate. They'll leverage life insurance. They put money into life insurance for the safety factors, and because you earn a higher interest rate than you would generally at the bank. And then they leverage against their money that's compounding the policy to put that towards real estate. Ideally, it's going to be real estate that cash flows, so they're getting cash flow from it. They're getting the property values appreciating, and they get the depreciation on their taxes went from the income they get from real estate. So that combination has worked very well for a lot of people. A lot of real estate investors love the idea of using life insurance to buy real estate. Then right above that, you start entering into market risk territory where you have developed market stocks. Above that, you have emerging market stocks. Above that, you have crypto. So there's a picture you see that looks like a barbell. That barbell represents how do I focus when I'm trying to build my wealth. Too many people try to do too many things on this chart. They want to do this, they want to do that, they want to do all these other things, and they don't have enough money actually working for them, compounding. And they keep going back and forth because here's what they're doing. They're trying to go to the moon. So they're trying to find this next thing and jumping and making too many moves back and forth because they're chasing stuff. You got to have a game plan. You game plan and you operate on what works. So this balance risks and reward and upside. So if I store my capital inside of a life insurance policy and I leverage that to buy real estate, and if I want to accelerate my wealth, I take a portion of that and I put it towards crypto. And I don't do a bunch of other stuff. Now you can do other things. Maybe your upside is emerging market stocks, or you want to day trade. You can still use your policy and you can do that as long as you understand what you're doing. You can use the money you take a loan against your life insurance policy, you can use that for any purpose, right? But crypto, if you can do that effectively, you can realize a huge upside if you understand how to not take on tremendous risk, where you can actually get passive income using digital currencies. And what I foresee is that people are having less and less interest, less and less confidence in the US dollar. So if you want to learn more about this kind of stuff, request a strategy call from us. We'll talk about how we're doing these different things. But a lot of it starts with how we're building out, using our life insurance policy for these different purposes. And then we use it for real estate, and we use it for other stuff. So you can go to 6buildingblocks.com/strategy. So here, Chelsea said that. You can say that part, Chelsea, since I've been saying.
Yeah, so if you want to request a strategy call, it's complimentary for the time being. It won't always be complimentary. And this is something that is really worth like over $1,200, really putting a financial plan together and customizing your incomplete financial house, going over these 6 areas, and then, showing you what your specific numbers would look like using a strategy like this to strengthen your financial house and truly make it unbreakable. And if you remember, an unbreakable financial house, it means that you can handle anything that comes your way financially. And beyond just being able to handle finances, you can really create the life that you want to live and the impact that you want to make in your life, your family, your business, your community, beyond, however far, for generations and generations. So think about what kind of impact in the world you want to make and how something like this can help you to accomplish that. Also, our free gift, we have a free gift for you. Our book, Let's Fight About Money, we have a free digital copy for you. And we'll put the link in there as well. And if you registered for this event, it will be sent out to you, the link to get that. So the link again for the strategy call, to request a strategy call, is 6buildingblocks.com/strategy. Tim can huff and puff and your house won't blow down. That's right.
Yeah,
Tim is the 3 enemies of your wealth: taxes, inflation, and market risk.
Yeah. So understand, guys, we're happy to share this information. We go and share information like this all the time. Make sure you get your strategy call. We'll get very booked this coming week. So make sure you go there ASAP and request a free strategy call with us so that we can at least show. So we'll go over some of the scenarios with you, show you what your numbers look like, and how you can use this strategy to do all the other things that you want to do. Because when you have clarity and you have clarity and you have confidence and you have consistency, when it comes to building wealth. You get there a lot faster and is a smoother ride. It's emotional when you lose money. So you don't want to lose money. You want to build consistently and have a smooth ride to building wealth to where you can become financially free. So anyway,
yeah,
thanks for
man.
watching. And if you have any other questions or anything, feel free to drop it in the comments. We'll go back and review some of this, but go and request a free strategy call ASAP and get a free copy of our book. So we'll talk to you guys later.
Have a great weekend.